So tonight we're going to cover current tax laws, some of the deductions and credits that are available, changes that are expected in 2026. And then I've also been getting a lot of questions as far as where best to retire. Does it make sense to maybe move to a different state to save taxes? So first thing I would like to talk about is the current tax law is called the Tax Cuts and Jobs Act. So the TCJA. It is scheduled to expire or sunset after 2025. Um, so currently there's no insurance requirements. We don't have to prove that you have health insurance to avoid a penalty. Most tax brackets are lowered. There's an increase in standard deduction. When you try to itemize, the state and local tax is capped at $10,000. So that's what that SALT cap is referring to. And then we also have eliminated personal exemptions for each household. So those are some of the major changes, what we've been used to over the past when it comes to doing taxes. The tax law is progressive. So that means that the first dollars that you earn are not taxed, and the last dollars that you earn are taxed at the highest rate. So you kind of work your way through tax brackets. Your first earned dollars are at 0%. Then you go into the 10%, 12%, 22, and so on. The Tax Cuts and Jobs Act shrank that 0% or the dollars that are not taxed at the beginning, but then lowered the amount of tax on those last earned dollars. So let's take a look at an example of a household versus current tax law and what we expect the tax law to revert back to in 2026. So we have a household making $200,000, have a couple kids, probably in college or near college age. You have mortgage interest, property tax, state income. So today, they would be using the standard deduction, which means that their taxable income would be $170,800. Federal tax liability be a little over $26,000. The effective rate is 15.6, and those last tax dollars are taxed at 22%. 22%. In 2026, same scenario. Now bringing back personal exemptions and being able to take advantage of that property tax and state income tax. So you're able to itemize. So your deduction is close to being the same, but then we tack on those personal exemptions for a household of four, means that your taxable income is actually going to be quite a bit less, under 150,000. So your federal tax liability nets out to be very similar, about 26,000, a little over. Your effective rate is higher, but you have fewer dollars that are actually taxed, and that last dollar is being taxed at 25%. Now, if we add on a little bit of charity in the same scenario, nothing happens. So under the current law, there's no credit for that $9,000 charitable gift. But in 2026, that's going to add to your itemized deduction. Everything else is going to stay the same. So your taxable income is going to be lowered. Federal tax liability is going to be almost $3,000 less in 2026 than it would be under current law. That effective rate is still at 17. Those last tax dollars are still at 25%, but your overall tax bill is quite a bit lower. Current tax law requires you to pay as you earn. So during our working years, it's pretty simple. You have payroll withholdings on your taxes. So there's not a lot that you have to do other than make sure that enough is being withheld. Um, the Tax Cuts and Jobs Act also introduced a new Form W-4, which is the form that we request taxes to be withheld, and at what rate. And that is a very difficult form. It does not read very well. Um, and because exemptions are gone, um, there's no claiming 0, 1, 2. That does not exist on that form, and that's what people are still trying to force into the form, and that is incorrect. So if you have questions on that, do not be afraid to reach out to me. I can help guide you the best that I can. Um, but there's a lot of confusion behind that. If you have tax deferred accounts, this is going to be IRAs, 401ks, pensions, those types of things. Um, Typically, you can have withholding set up on that as well, and that is going to be a taxable distribution when that money comes out. IRA withdrawal or Roth IRA withdrawals is not taxable, so there's no need to withhold taxes on that. Interest, dividend payments, capital gains. There's really not any way to have taxes withheld on that. For the most part, it is a taxable event, so we have to make up for that through either estimated payments or withholding more tax from other income sources. If you're doing Roth conversions, typically you want to make estimated payments on those as well. Last resort, you can do withholding, but we discourage you from withholding the tax on that conversion because now you have fewer dollars going into the Roth IRA to pay those taxes. So we want to put the full conversion into the Roth and pay the actual tax from a separate account. If you have self-employment income, rental income, other forms of business income, you're going to have to make estimated payments to cover that as well. If you have Social Security, there's a good chance that it is going to be taxed. There are some lower income levels that Social Security will not be considered taxable income, but you'll want to set up withholdings on that if you are earning more than those minimum thresholds. If you realize a capital loss or take income through a cash account, just bank account, it's not going to be taxable, so you don't have to worry about withholdings there. If you under withhold or fail to make payments, there are interest penalties at the end of the year. Estimated payments are broken into 4 quarters: April 15th, June 15th, September 15th, and January 15th. The federal government does not realize that that is not equally broken out. That's just how the rules are set up. So the first quarter is 3 months, the second quarter is only 2, then we go to a 3-month quarter, and then the fourth quarter is 4 months. Just how the rules are set up. I did not make those rules. As I just mentioned, failure to pay the correct amount as you earn throughout the quarter can result in an interest penalty. In previous years, the interest penalty was pretty low because interest rates were relatively low. Around 2 to 3% was the annual interest rate. This year, I believe it's 7.5. I've seen as high as possibly 8 that can be charged on those underpayment amounts. So it does add up as interest rates have increased as well. When you make these payments, you want to make sure that you keep track of them because third-party tax preparers, myself, or if you use someone else, there's no way for us to verify that you have actually made those payments. So we want to make sure that we include the correct amount for the correct time frame that they were paid on your tax return to avoid any errors. If that's not included on the tax return, you're going to get a letter from the state of Wisconsin or the Internal Revenue Service saying they've corrected this. This was unreported and your taxes were wrong. Typically, it results in a refund because you made a payment and we didn't tell them on the tax return that you did make that payment. So this is a little bit more detail as far as how much do you have to pay in estimated payments to avoid a penalty. Um, there are three tests. You can either pay 100% of last year's tax liability. So this is not going to be if you owed money at the end of the year, if you got a refund. This is going to be the total tax liability. So it doesn't matter how much was withheld. If you earned $100,000 last year and your tax bill was 9,000, you had 10,000 withheld, you get $1,000 refund. You have to have had at least that $9,000 withheld this year to avoid a penalty. The other test would be 90% of the current year's tax liability. So if your income goes way down, you don't have to have nearly as much withheld because of last year's 100% rule. But you have to be within 90% of what the total tax bill is at the end of the year, or within $1,000. So whichever one is going to work for you. If you meet one of these tests, you've met all of them. So, but that is how you avoid that interest penalty. So there are plenty of years where there's still taxes that are due at the end of the year. But if you meet one of these guidelines, there's not going to be that penalty added on. So as we're talking about, should I move because of taxes? This is kind of where I'd like to start. The states in green do not tax retirement income. So a few of these states do not have income tax at all. A number of them do not tax pensions, IRA withdrawals, or 401k withdrawals, basically any kind of a retirement account. There's not going to be taxes on that as income in all of these states that are highlighted in green. So does it make sense to move there? Well, there are a lot of other factors when it comes to cost of living. Talking about property tax. So the red states here have the highest property tax rates in the country. The state with the highest property tax rate overall is Illinois, our neighbors to the south. And Illinois is very unique. Cook County is the reason that their property tax is the highest in the country. That's Chicago and the surrounding suburbs. They drive up the entire state. If you live in the south or the west part of Illinois, property tax is actually pretty average. But if you are in the Chicago area, that is the reason why the entire state pays the most in property tax. So you'll find that there are definitely some regions within states that are very different for cost of living as well. The lowest property tax rates actually are mostly out west. The states in green here are going to be the lowest. Surprising that Hawaii is also on this list, but this is where you're going to save the most on that house that you own. Where is it the most expensive to buy a house? So this is the highest home values per square foot. Kind of not surprising, California is on that list. Hawaii is also there. Florida, usually nicer weather results in that. But this is where you can expect to pay the most for a home. And then also probably not surprising that New England is also quite expensive. States with the lowest home value, so where you get the most bang for your buck, a little bit in the Midwest and then the South. So this is just going to show exactly where you can get the most house for the least amount of dollars. So the number of homes for sale in the entire country right now is around 1 million homes. So these numbers were effective the end of June this year. And the staggering thing is that 1 out of every 3 homes for sale is in the state of Texas or the state of Florida right now. So what this tells me is that if there's going to be a housing bubble, I don't think it's going to be national, but I think it could be regional. And Florida and Texas are the 2 areas that will be affected the most. Texas is actually overbuilt. They have more new homes for sale than existing homes, and they just have more inventory than what they probably should at this point. Florida is a completely different animal right now. Florida has vast majority of these homes are existing homes that are for sale, and it's difficult to find buyers in Florida because of the need for property insurance if you have a mortgage. Property insurance has gone through the roof in Florida, so it's very difficult to secure a mortgage. So most people have to be cash buyers to buy existing homes in Florida. Right now, 20% of homes do not have property insurance on them at all because it's just not affordable, or not. There's no company that's even offering insurance in their market. The highlighted states here are going to be all the states that do not have income tax on there. This is just going to be regular income tax. It did not highlight the states that do not tax retirement income. But as you can see, the home value inventory that is higher is actually some of the states that you typically think are the ones that you should retire to. So the other thing to look at is population ratio versus a home for sale. So Texas is on the high end, but it's not that far out of line with the rest of the country. So we're at 0.52%, going all the way down to 0.1 in Rhode Island. But this is kind of in line with the national average over the last 10, 15 years. Florida is very much an outlier. So can expect homes in Florida pricing to come down over the next few years. So if you are looking to move to Florida, I would say definitely be patient. And I would expect those prices to come down in both Florida and Texas, but really Florida would be the spot. So if we compare Dane County versus Florida, most of our clients are here in Dane County, so I don't want you to freak out and think that your home is losing value because there's a lot of talk on the news about how home values are reducing their prices that are for sale. 25% or 1 out of every 4 houses in Florida did see a price reduction within 30 days in the month of June of it being listed. In Dane County, that was just under 10%. Florida is selling through 10% of their inventory over 10 days. Dane County is selling through 50% of their inventory every 30 days. So what does that actually mean? The amount of homes that are for sale that are coming through versus what's being sold and what's coming onto the market. If Florida continues at their current pace, it will take 3 years for them to sell through their entire inventory. Dane County will take 3 months. So, those numbers don't look like they're that big of a gulf, 10% versus 50%, but it's a huge difference. So the housing market in Dane County, Wisconsin in general, but Dane County specifically, is still extremely healthy. Most homes are selling very quickly at asking or even above. Whereas in Florida, part of the issue, again, goes back to that homeowners insurance. If you're not a cash buyer, you have to have homeowners insurance, and it's very difficult to secure homeowners insurance. Um, so if you're trying to get a mortgage and buy a house in Florida, it's an extra hurdle to jump over. So speaking of those higher property insurance rates, most of the country is very, very average. Average $300,000 home, it's about $1,900 to insure that property across the board. All the states in blue are plus or minus just a few percentage points off of that. The states in green are the outliers. And it shouldn't come as a surprise. After I thought about it, it made total sense why Nebraska, Kansas, Oklahoma, Louisiana, Texas, they're higher. Now, they're only about double, 2 or 3 times higher than the average, but that's Tornado Alley. And there's really no protection or warning of a tornado coming and wiping out your dwelling. So that actually makes sense to me. But then we look at Florida, Louisiana, Texas, they're all also susceptible to hurricanes. So Texas gets both. They get a lot of tornadoes and they get hurricanes. Florida is 5 to 20 times higher than the national average, depending upon how close you are to the coastline. And that's just on average. If you are beachfront, it could actually be more than 20 times higher than the national average. There are some $300,000 homes that cost $20,000 a year in insurance that are beachfront property. I don't know what beachfront property is $300,000, but those were the stats that I was able to find when I was looking up this information. So there's definitely a lot of other factors when it comes to what state should I be living in. The last thing that we're going to talk about is going to be sales tax. So there are a few states that don't charge that extra 5-6% when you buy something. Those are the ones in green here. So you've got New Hampshire, Delaware, Alaska, Montana, and Oregon. So those are going to be your safe havens if you buy a lot of stuff. But what is average, or what is a high sales tax? So the states in red are going to have a state sales tax with 6% or higher. So we see a couple of our neighbors, Minnesota, Illinois, Indiana, they're all around that 6% or a little bit higher. Texas, no state income tax, but they have higher sales tax. This is going to be the statewide. Now, Wisconsin's statewide sales tax is 5%, but a lot of places you go will charge 5.5%. I think Milwaukee is actually maybe even 6%, because they have those local additional add-ons. So if we look at that, some of these states have more than 8% sales tax in their highly populated areas. Going to pick on Cook County again, Chicago. They're close to 12, 13, 14% in some different areas of sales tax. And that's not going to just be hotels. Hotels are a totally different tax altogether. If you've ever traveled, you'll see that sales tax on hotels are normally 14 to 17%. We're talking just regular run-of-the-mill goods that are being purchased are at extremely high sales tax. So again, a lot of factors go into, are we saving money by relocating? So talking about this, does it make sense to move to save money on taxes? Short answer, not really. It doesn't matter where you are in the United States. there's one way around that you're going to be kind of in the same ballpark as everybody else. Other factors that we didn't really touch on, access to healthcare, um, access to mobility, how close are you to an airport if you want to travel, those types of things are all definitely things to consider. Am I saying to avoid any state in particular? No. If you want to live somewhere because you have family there, you love the weather, you love a certain area, go for it. But should we flee Wisconsin because we have a little bit higher sales tax or income tax? Not really. You're not saving much if you go somewhere else. But if you want a few ideas on places that you could save, I kind of broke it down by region. So if you want to live in the Pacific Northwest, I would live close to the border between Washington and Oregon, so you can buy stuff in Oregon and live in Washington. It's a little cheaper to buy stuff, and there's no sales tax in Oregon, but most of all other taxes are a little bit lower in Washington. If you want to live where it's hot and dry, Nevada or Arizona, Nevada's a little bit better. Stay away from Vegas. Stay away from Phoenix. Those are going to be your areas that are going to spike in property tax and sales tax and the cost of housing. Surprisingly, Illinois is actually a pretty good spot to retire if you want to stay in the Midwest. Just stay away from Chicago. Everything else is pretty affordable in Illinois. Iowa is also somewhat affordable. South Dakota has some advantages, but again, you're getting kind of rural. If you want to go to the south, where it's warm but not dry, Georgia, Mississippi, Alabama. Again, you want to be kind of conscious of other things such as access to healthcare, mobility. I would say Georgia probably has the most amenities. And then Tennessee is also, not a bad spot as well. If you want to go up to the East Coast, New England, New Hampshire is probably your best bet, but you're still going to have a lot of money to buy a house up there. So probably not a definitive answer of, hey, does it make sense to move to anywhere specific? But again, have a better reason than tax savings or expense savings. So with that, I'm going to turn it back over to Jacob. He's going to talk about our upcoming events, and he'll let me know if we have any questions floating out there.
Oh, thanks, Luke, for covering all of that. There is still time to get your questions in on the chat box. I wrote down a couple, and I also had a couple that were entered beforehand. So first one we'll start out with is, do estimated taxes due January 15th of 2025 get credited towards the tax year 2024 or 2025?
Yeah, so the January 15th deadline would be for the previous year for the fourth quarter of that year. So if you pay your tax estimated payment by January 15th of 2025, that's going to go towards what you earned in the fourth quarter of 2024 gets credited. So yes, good question.
You talked about penalties for late payment or underpayment. How would you describe or estimate what those penalties are for the amount?
So it's based on prime interest rates. Previously, it wasn't that big of a deal when interest rates were low. But this year it is, I believe, published at 7.5% interest on the amount that you should have paid that you failed to pay annually. So example of that, if you did a big Roth conversion in December at the end of the year, and you just said, you know what, I'm not going to make that estimated payment. They're not going to charge you 7.5% interest on that additional tax for the full year. It's just going to be for that fourth quarter. So it will be prorated around, what's the math on that? 2.5, 2.25, something like that. So those rates are published on the IRS's website if you are looking, and they change every month, what it's going to be based off of. But the last time I looked, it was around 7.5%.
Perfect. That answered another question we had. Another one that just came in. How will one be taxed on U.S. retirement, including Wisconsin retirement system, pension, and Social Security if one decides to reside abroad or retired?
So if you maintain citizenship in a patriated foreign country, it should be about the same as if you were in your previous resident state. So there are countries that are friendly to the US: Australia, Canada, Mexico, England, most of Europe. If you are in a hostile or non-treaty based country, and there's probably not a lot of places that you'd want to retire that falls under that, but somewhere maybe like Indonesia, Thailand, something like that, you might be subject to double taxation. But if you're living in a country that plays well with the United States, you will pay whichever tax is higher. So either the US tax rate or the local tax rate, and you'll get full credit for the other one to offset the foreign tax.
All right. Can tax paid on a new car be deducted on your tax form?
Yes, it can be, but that's going to fall under that state and local tax. Most of the time, your state income tax is going to be higher than your state sales tax that you're paying. Just because Wisconsin income tax pretty much starts at 5%, sales tax is 5%. So you'd have to track all of your purchases, not just those big purchases, to overcome just kind of that normal 5% income tax. So you get to choose one or the other, either sales tax or income tax.
All right, thank you. How will the pending tax changes impact possible Roth conversions?
So when we are talking about Roth conversions right now, we're almost always looking at what is your income going to look like in 2026 when the tax laws revert back. 9 times out of 10, there's going to be some tax savings, but there are definitely a few cases where I've said, hey, this actually makes sense to wait, because we want to realize as much taxable income at the lowest possible rate in the future. So if you're going to work until the end of 2025, your income is going to go down, switch on Social Security, and then take a small draw from your IRA. It might be a lower tax rate than it currently is. So we definitely want to look at that a case by case scenario. But in general, right now we're doing a lot of Roth conversions because we know those last dollars are going to be taxed at that higher rate.
All right. We still have some time, so if you do have other questions, put those in the chat box. I have one here. Will there be any state law changes that you're projecting or expecting?
I haven't really heard of anything. Wisconsin didn't change their state income tax laws with the Tax Cuts and Jobs Act. They still have personal exemptions. They still kind of go off of the old federal rules. So Wisconsin would actually fit better in line with their current rules if nothing happens and we go back to the old rules.
All right. Well, I'm not seeing any new questions, so I think you answered everything that you can possibly ask about taxes, apparently. But so thank you for lending your expertise. And if you have more questions that come up afterwards, feel free to email your advisor, reach out to us at the office, and we can relay that to Luke and get you an answer later on. So again, thanks, Luke. Do want to preview our next 3 events that will be happening this fall. So in September on the 19th, we're going to have a professor from UW-Madison Professor Vanessa Leon. She is going to be presenting about circadian rhythm. So this is going to be a health-based webinar, and going to be talking about how circadian rhythm and exposure to light and eating can affect your metabolic health and your gut microbiology. So she's been on PBS Wisconsin and has presented. So I'm really excited to see what she has to tell us about kind of an underlooked facet of our health. And then October and November, we'll shift gears into a little bit less education, a little bit more fun. So in October, we'll have a pumpkin design contest. So it's not necessarily carving. You can paint, decorate your pumpkins however you like. Get your family, your friends, your neighbors to join. There will be prizes and obviously bragging rights available. So look out for emails and more information about that. We've been doing that for the last couple of years and had a lot of fun with it, seeing, and there's been some pretty impressive designs that we've seen over the years. And then in November, we'll be doing our second charitable event of the year. So all month long, we will have a charity drive. This year, we'll be participating in our specialty carefree clinic in the Verona area, and in Brookfield, we'll have the Walk Shop Free Clinic. We'll also apply drives for them. So we will be communicating some more information about that, but we'd love to have any of your support that you're willing to give and help us give back to the community. So it looks like we did have a couple of other, one more question that came in. So I'll answer that or send that to Luke before we sign off. If I convert an IRA to a Roth IRA in September, will my estimated payments be due in January of 2025?
Yes, yeah, so September 1st starts the fourth quarter, so you'll have till January 15th of the following year to make that estimated payment. Yep.
Thank you. Well, I think that was the last question I saw. Again, yeah, thank you everyone for joining us, and those that ask questions, thank you for that as well. Hope we answer some of your questions going forward, and yeah, thanks for all the support for WDS, and we'll see you in September, hopefully.